Okay, so let's pick back up with this example. There's some slides just following this that I think we're going to skip because they feel a little complex given how this is digesting. But there's one thing about this example I want to just kind of clarify and see if we can test your knowledge on before we move on to other stuff. So in this example, we had a situation where there were two DTLs, one for fixed assets and one for intangibles. Right? So these are our DTLs. That's one, that's two. And what would this company do if the target had an NOL? Let's say the target had an NOL of 100. What would we do? How would we account for that if we're the buyer? Okay, so if we use the same kind of logic, right, and that logic being we're trying to capture on the opening balance sheet for the buyer all of the deferred taxes of the target, even though they've been kind of reset based on all these accounting fictions. How would I deal with the fact that there's an NOL? What would I do? Anybody? Okay, John? I need to book a DTA, right? So if I'm booking all the deferred taxes and liabilities for this thing, an NOL is just another type of deferred, right? It doesn't pop out of some sort of book versus tax basis difference, but an NOL is an attribute. It's going to carry forward. It's going to save me future tax. It sounds like a deferred asset, right? So if I was going to book a deferred asset, so I'd have to book a debit to DTA, let's just say for 40. Asmita, what would I book my credit side entry to? I got to balance my balance sheet. Credit my provision. Kawai, what do you think? Goodwill, right? So my 40, my balancing 40 is going to go over here, right? Or more likely I'll net down my debit entry to Goodwill. Okay, so this can go both ways, right? I just want to make a very simple example out of an NOL that said, even though here I'm recording DTLs, with an NOL, I could record DTAs. And it's very common to have some of both, right? Some DTAs, some DTLs, very common. Okay. So one of the main reasons that we have to do this accounting, so let me just kind of create an example from this. Okay, so let's start with this example here. And let's talk about what happens in the future. Okay? So if I had $1,000 of intangibles, let's say that the next year, I acquire this company and then the next year this happens. So let's say that I had revenues of $10,000 and I had expenses of $6,800, and then I had amortization of my IP. Remember, my IP was $1,000. Let's say it's 5 years. So for books, I have an expense of $200. So my PBT for books is $3,000. Revenues?
Oh.
I know, my writing is awful. I'm telling you, it's the touchpad. Okay. So revenues are $10,000. I have regular old everyday expenses of $6,800. And then I have intangible amortization. My 1,000 over 5 years is 200. Okay, so I have PBT of 3,000. Okay, so what is my taxable income? So if I was doing my tax return, what would be my taxable income? I would start with my PBT of 3,000, and what would be the adjustment that I would make? 200 of amortization is non-deductible, right? So that's my IP amortization. So my taxable income is going to be 3,200. So my tax rate, I think I use 40%, 1280, right? So my payable is 1280. So that's step one. Step two, when I do my deferreds, my beginning of the year deferred was 400. Remember, it was the $1,000 basis difference times 40%. At the end of the year, I'm only going to have 800 left of basis for books because I amortized 200. So this has got to go to 320. So my change during the year must have been 80. Right? So that means my journal entry would be credit payable for 1280, debit DTL for 80, debit provision for 1200. Okay? And that's what I would expect, because 3,000 of PBT times 40% would get me 1,200. So I have no perms, right? So the important thing is that this 200, that feels like a perm, right? Because books is going to expense 200, tax is never going to get a deduction for it. We're not getting a deduction for it today, not tomorrow, not ever. But it's a temp because we had a basis difference on our opening balance sheet that allowed us to acknowledge the temp difference. So that 200 is just simply the unwind of that temporary difference we set up in the acquisition. Okay? So sometimes that's hard for people to process, that how come that 200 is not a perm item, because it's never deductible. And the answer is we're reversing that temp that we set up on day one, and our deferreds are slowly going to decline as we recover that book balance. Okay? So this is important because if you didn't set up this DTL, then in effect you wouldn't have that entry and your provision would go up. Right? You don't want that happening. So you want to get those deferred liabilities on that opening balance sheet to protect you from that ETR hit down the road. Right? And the only thing you're really exposed for from an ETR perspective is that goodwill impairment that we talked about. Okay? All right. So in general, books is putting fair value on their balance sheet. You're going to compare that to tax basis and identify any differences. You'll book the deferreds for anything but goodwill, including things like NOLs. Okay? And then you'll roll those deferreds out just like there are any other temp difference items that have deferred taxes. Okay? Okay, so I'm going to skip through this stuff. And let's talk about this we'll do section 3 here, and then we're going to do problems, I think. Okay, tax attributes. So, one of the things when you're a buyer and you're acquiring a target, if you're a tax person, you're going to want to do due diligence and learn everything you can about a target company, so you know what you're buying, basically, right? So if you were a buyer and the target had NOLs, you would ask, well, are those NOLs any good? Are they limited by 382? Do I have other exposures where the NOLs will just be whittled down to some smaller number? Right? You're going to want to understand what's going on. So as you're looking at a target, you kind of have to look at them with your FIN 48 glasses on, right, to figure out if what they say on the return is really going to be, is really going to kind of hold water at the end of the day if challenged by a tax authority. So you got to think about uncertain positions in FIN 48. And the next thing you got to think about is valuation allowances, and this is a tricky area. So when you think about valuation allowances, remember what we said a valuation allowance stands for. It stands for the view that a company might have a deferred asset, but that deferred asset might not ever be used because the company may not ever need to save tax unless it's profitable and would otherwise pay tax. Right? That's what a valuation allowance is there for. The absence of future income. Right? So in the context of an acquisition, when you're talking about valuation allowances, it's important to think about, is it the buyer that has a VA or the target? Or both? Okay? Because we're going to get some pretty different answers depending on what the assumptions are. So it's entirely possible that the acquirer has a valuation allowance, but the target doesn't. Right? Totally possible. It could be that the buyer is very profitable and doesn't have a valuation allowance, but the target's been losing money and the target has a valuation allowance. That's pretty common. Okay? But as we think about valuation allowances, first think, whose are we talking about? Whose or both? Okay? These slides are in there because for the longest time we had to teach people two sets of rules, and we'll cover this a bit, but the current rules have been in place now for 4 or 5 years, and so for you guys, man, the new rules are the rules. But through some of the examples in a bit, we're going to show how you would get different answers pre and post rule change, and it'll just show you how dramatic the change in the rule set really was. But know that the current set of rules have been in place for a few years. Okay. So, if you have a valuation allowance or an uncertain position, so let's say that let's use an uncertain position for starters. Let's assume that you were a target company and you took a really aggressive position on your tax return to let's say you deducted all your meals and entertainment. Okay. And then buyer acquires you, and a year later, the acquirer gets audited, the target's books are looked at, the IRS sees you've been deducting all your meals and entertainment, they want to disallow the position, so now you as the buyer, you have an exposure, right? Because you bought the stock of the target, you inherited all their problems, okay? So you need to accrue an exposure, right? The credit side of your entry is going to be to accrue a liability. Oh my gosh, I just did that. The credit side of the entry is going to be to book a liability. The question is, what is the debit side? Okay. So if you discover this a year later, or some fact changes shortly after the acquisition to help you kind of realize what this exposure is, under the old rules, you would have the potential ability to book that to goodwill, even if the event was after the acquisition. And so that's a good answer, right? Because companies would say, now I have kind of the luxury of time to go figure out all these kind of skeletons in the closet. And as I realize kind of what my exposures really are, I can just adjust goodwill. Under the new rules, any adjustment after the measurement period, which is generally the period that starts with the acquisition date and goes up to a year, but only for facts that existed as of the acquisition date, any other adjustment goes to provision. So if it's a year and a day later, and the IRS comes in and realizes that you have all this meals and entertainment that you've been deducting and you have a big exposure, now you have to accrue that to provision. Okay? So it's important for companies when they're doing purchase accounting to capture the effects of valuation allowances and the effects of uncertain positions correctly on day one, because if you don't get it right on day one, you end up booking all those adjustments later to the provision. Okay? So that puts a lot of pressure on the person doing the tax provision to know what all those exposures are, to know what the valuation allowance issues are. And sometimes when a company does an acquisition, it takes time to get the target's tax returns, to get the target to actually talk to you, to kind of learn what's going on. Sometimes you don't know it right away. And so the pressure of getting it right early because of this rule, combined with the fact that it's hard to get the facts early, that makes life complicated for companies that do acquisitions. Okay. So let's go through a couple valuation allowance examples. So let's say P, parent acquires T, target, in an acquisition 2 years ago. So let's say that target had an NOL of 500. So buyer, P, they did not record the benefit of the NOLs, so they booked a DTA with a full VA. Okay, because for whatever reason, they looked at those NOLs and they're like, we're probably not going to need them, we're probably not going to use them. But I guess what happened was there was an increase in profitability of T, so now all of a sudden you can use those NOLs. Okay, so you bought the company, it had NOLs, you didn't book a DTA, net of a valuation allowance, because you didn't think you were going to use them, but then things changed and now you realize you can use them. Okay, so what entry should you book to record the NOLs? Right, so we know that we're going to book debit DTA for the NOLs. The question is, what do we credit? Okay. So under the old rules, which I realize are really old, but it's just interesting because the effects are so different. Under the old rules, you would actually book it to goodwill. And it doesn't matter if that happened 2 years after the fact or 100 years after the fact. You would look at those acquired attributes and say, if I ever got a benefit for them, I would book it back to goodwill. And so before the rules changed, provision people had to actually do tracking of their attributes to figure out which ones were goodwill related. Under the new rules, boom, it just goes to provision. Okay? So this presents like a very obvious dilemma if you're a provision person. Okay? So, if you acquire a company and you think you're going to use their NOLs, but you're not sure, are you incentivized to book a deferred in your opening balance sheet, or are you incentivized to book a valuation allowance? Forget what the right answer is. What are you incentivized to do? What are you motivated to do? What's that? A DTA what? Well, so let me make sure I'm being clear with my question. So let me just create another slide. Okay, so if you book an NOL in your opening balance sheet, you're going to debit DTA, credit goodwill, right? If you no longer, like 2 years later, 3 years later, you're like, I can't use that NOL, this isn't good, you have to credit DTA, and debit what? Provision. Sorry, this credit entry is essentially valuation allowance, same thing. Okay, so I have to debit my provision. So if by contrast they said, you know what, I'm not sure I'm going to actually use my NOLs, so I'm going to book nothing here. I don't know. And then down the road, if I need to say, you know what, I'm definitely not using those, then I still have nothing to book because I didn't record anything in the first place. And if I do end up having to use them and I say, yeah, this is great, I didn't think they were worth anything, but then they became valuable to me, then I debit my DTA and I credit provision. So knowing that the subsequent accounting is all going to be through the P&L, that kind of biases you in terms of what you put on your opening balance sheet, right? That's not the way it's supposed to be. I mean, you're supposed to just do the right thing based on the facts as they're presented to you. But people can't help thinking ahead in terms of what's going to happen down the road based upon a variety of future events. So the same thing is true for FIN 48. Okay. So let's use FIN 48 as an example. So if I acquire a company, and I think they have some exposures, but I'm not sure, so I might book an opening balance sheet for FIN 48 liability, and I would debit goodwill, right? If down the road I didn't need that FIN 48 liability, I would debit FIN 48, and I would credit provision. Okay? However, if I didn't book anything, if I wasn't sure, I'm like, I'm not sure there's exposure, and then all of a sudden that there was, down the road, I actually have to expense that, debit provision, credit FIN 48. And the best that can happen is I still don't need an exposure, so nothing happens. But I'm at risk for having a provision expense here if I don't accrue it here. Right? So people are incentivized to protect the future, right? Because no one wants that. Right? And so you err on the side of being very conservative in purchase accounting now. Because setting up FIN 48 liabilities here, right, sets you up for a good outcome later. And not booking a DTA here, right, helps you avoid booking a charge. So again, I say this not to tell you how to game a purchase accounting. I tell it to you because the way the rule works in terms of making adjustments through the provision later, whereas you book day one entries through goodwill, the accounting is just so wildly different that people can't help but let that factor into their judgment calls when there's something that's in a gray area. Right? So keep that in mind. Okay, so let's go through this simple example. Okay, so let's say P acquires T in an acquisition 2 years ago. T had NOLs of 500 tax affected. P records the benefit of the NOLs because it thought it was going to use them, but then there's a downturn in the economy. What entry do you book? So now, and even under the old rules actually, if you need to take a DTA you booked on the opening balance sheet and set up a VA, all that runs through the provision. Okay? And that's why I was just saying, some people would err on the side of booking a VA in the beginning so that they avoid that provision hit down the road. All right, but sometimes you can't tell, right? Maybe the economy just completely swooned and you didn't see it coming. Okay, so now we're going to twist from having the target have valuation allowances to the buyer. Okay, so we're an acquirer. Okay, let's say EA. Let's use them as an example. EA had this exact situation. So they're buying a company, but they've been losing money because you guys are not buying enough games, right? So they have losses. They have a valuation allowance on their provision. So, but they go out and buy a company, and that company doesn't have valuation allowances. Okay, so now we're going to figure out what happens. And think that they're buying a company that looks like this. They're buying a company that looks like that. Okay? So it's got a bunch of IP, it's got no tax basis, it actually has a ton of DTLs. Okay? So even though EA's been losing money and has a valuation allowance and things look sort of bleak, it buys this company that looks like, the exact opposite. It has no basis in assets, it has DTLs, and so normally you wouldn't book DTLs when you have a valuation allowance because you just kind of let them mesh with the DTAs you have that have a valuation allowance on them. But we're going to see how that works out in a second. Okay, so pretend that they buy this company, but they, the buyer, have valuation allowances. So, if EA has tons of NOLs with a valuation allowance, and it acquires a company that has IP that creates a DTL, if that IP was sold for cash and there was a tax gain, could we use EA's NOLs? The answer is complicated, but let's assume yes. Okay? So there's a Section 384 would probably stop it, but let's assume that 384 doesn't exist and you can use those NOLs. Okay? So if that were the case, then that would mean that we could reduce the acquiring in these valuation allowance, because we would look at the target and say, oh, you've got this DTL, and that DTL will allow me, the buyer, to use some of my DTAs. Right? Because if you sold your IP for cash and there was a gain, I'd be able to use my NOLs. So now those NOLs suddenly became valuable. They're valuable to the extent that you, the target, had DTLs. So oddly enough, buyer in an acquisition could reduce its valuation allowance to account for the fact that the target was bringing DTLs. Okay? So let's assume that happened. Let's assume that EA is a buyer, it's got a valuation allowance on its DTAs, and it acquires a company that looked like that one in that simple example with DTLs. Okay? So the question is, what do you do? Right? And here's one of those where you'd think, if you go through our basic provision steps, there's not going to be any payable. At the end of the day, there's still a huge net DTA with a valuation allowance. So the deferreds are really nothing still. So even though I got this company with the DTL, I just kind of like swallowed them, right? But my net deferred stayed at 0. So my payable didn't change, my deferreds didn't change. You kind of think the answer is nothing happens. Right? Like that's a logical answer. But the accounting is super different. So the way the accounting works, let me just kind of show you the current accounting on this page first. The way the accounting works is first you book targets entries. Targets entry was debit goodwill, 420, credit DTL, 420. So then we go to buyer. And if we assume that all 420 of those DTLs would allow us to use 420 of our buyer DTAs, we would book debit DTA or release our VA, depending on how you want to look at it. And then we need to credit something. So here's the funny thing. We credit provision. So net, right, the DTL and the DTA entry is offset. So really all you have is a large debit to goodwill and a large credit to provision. So about 2 years ago, EA went out and bought a big software company, gaming company, and it had this exact fact pattern. And this entry right here, I want to say it was like 50 million. And so it looks so funny in their financial statements because you're like, hey, we're a company that's losing money, not paying taxes, we have no deferreds. We just bought a company, so we're going to book 50 million of tax provision benefit. Right? That's what happened. LSI did this too. LSI's chip company over in Milpitas, not far from here. They bought a company, not this year, last year, about 18 months ago, and it was around the same magnitude. It was about 50 million bucks. Where that's a company that has like 2 billion of NOLs, hasn't paid tax in like, since most of you were born, and has a valuation allowance on their DTAs. And then, so they would say, it's really peaceful here, there's nothing going on, our tax expense is really small. All of a sudden we buy this company, and, boom, we book this entry, that's easy. But then when we look at this, and we got this giant provision, I mean, they've never booked a provision benefit like that ever. Right? And so trying to explain to somebody that's reading your financials, they'd be like, well, why did you book a provision benefit? And the answer is, I bought a company, and that company came with these liabilities, and the good news is, I've got these attributes, I can use them to soak up those liabilities, so I get a provision benefit. It doesn't feel like that should be a P&L item. It doesn't feel like when you buy a company, you should get a P&L benefit for the provision. That's a strange accounting. But this fact pattern is not uncommon. You see this fairly frequently. Because companies that have NOLs and valuation allowances, they're buying targets too, and most targets look like that simple example earlier in the deck. Okay? So the fact pattern is not uncommon. Okay, so before we get to this slide, let's go through the in-class exercise and see if we can get you to think some. Because trust me, you will need to know this. Okay, so let's do, so I have in-class exercise 1 up on the board. So Target Corp was bought by buyer for $10,000. Target Corp had $8,000 of NOLs that were not more likely than not to be realized. And the purchase price allocation is below. Okay, so I want you to tell me what the opening balance sheet entry is. Okay, so that I think you will find easy. So I want you just to keep going and continue to part 2, which is now on the screen. So, part 2. This one will be a little harder. So for book purposes, you should assume that fixed assets and intangibles are amortized over 5 years ratably, linearly, on a linear basis. For tax purposes, fixed assets are depreciated over 5 years straight line. Buyer has little profits and no beginning DTAs. Tax rate's 35%. And then assume that in years 1, 2, and 3, we have the book loss and profits as shown below. And assume that in those book losses and profits is the depreciation and amortization from the acquired intangibles and acquired fixed assets. So for example, in year 1 it says there's book loss of 200. Well, if we're using a 5-year life for fixed assets and for intangibles, assume that 400 of my fixed assets is depreciated and 1,000 of my intangibles is amortized in that book loss of 2,000. Okay, assume that's part of it. So I want you to figure out the provision in years 1, 2, and 3. Figure out what your opening balance sheet entry is, and then do the provision in years 1, 2, and 3. There's very little activity here, so it should be fairly quick to figure those out. Okay, but the point of it is to show you not only how would you set up your opening balance sheet, but then how does the future effect of that book accounting, how does that roll through? Okay? All right, so why don't you guys work on those problems 1 and 2 here for a bit. Okay, so we're going to start with the opening balance sheet entry, and then we're going to move on to the second part where we go through the consequences in years 1, 2, and 3. Okay, so Target was purchased by buyer for $10,000. The Target Corp had $8,000 of NOLs, not more likely than not to be benefited. The purchase price allocation is below. Okay, so what are the DTAs and DTLs on our opening balance sheet? Anybody? What DTA do we have? Nellie? What DTA do we have? NOL. Alright, we have an 8,000 temp item for NOLs. Okay. DTLs. What kind of DTLs do we have? Intangibles, right? Okay, how much is that? 5,000. Okay, so we actually have net 3,000 DTA. Our tax rate is 35%. we have 1,050 of DTA with 1,050 of valuation allowance. So we're going to book nothing on our opening balance sheet. Right? So we're going to say that if we had this DTL right here, if we sold our IP for cash, it would produce gain. That gain would just offset these NOLs. So all we'd really be left with is excess NOLs of 3. And tax affected, that's that number, and after the VA, it's that number. Okay? So easy. Okay? If we didn't have a VA, just for fun, what would our journal entry be if we didn't have a VA? Joe. Debit DTA for 1,050 and credit what? Credit goodwill, 1,050. Okay? Definitely need to know how to figure that out. Okay? You gotta know how to put deferreds onto your balance sheet through an acquisition entry, kind of separate and apart from the rest of your provision. Okay? So what I would do if I were you, so this is my hint on how I would do the final if I were you. So remember how when our provisions kind of got more complicated, in our deferred schedule we kind of said, you know, beginning of the year, end of the year. We had, you know, like a return to provision column maybe. We had a current year activity column. And you might even have an acquisition column. And the reason I would do that is I would show every one of these columns as producing a journal entry. So for example, like this current year column, we know the other side of that ends up going to the payable. Right? Because the temp difference on a bad debt reserve is just going to flip on the payable for the bad debt reserve impact to the current. This acquisition column, deferreds will go up and down, but the other side of the entry will be goodwill. Right? So sometimes it's better not to put kind of too much in one column, especially when the other side of the entry is different. Right? So the template we sent you doesn't necessarily have it all formatted for this, but it's just Excel. You can change it. Right? So think about how format-wise, if you were going to do an acquisition, you might want to build it in. Because just like Joe was saying, yeah, that's the journal entry, but now you got to get it into your provision, right? And include it with all the other stuff going on in your provision. This is just one of many things that'll be happening. Okay? And if you remember that account roll forward towards the back of the provision model, right? Like this might be one of the rows that you show, but show it separate from everything else, right? Keep it clean, keep it easy to follow by saying, you know, okay, here's my acquisition entry, right? And then move on and talk about here's my current year deferred movement entry, right? Keep those things separate. Don't just try to book everything at once in some one gigantic entry. Okay, so that's our opening balance sheet. Let's go on to, okay, year one, book loss of 2,000, assume no NOL carryback if NOL is possible. Okay, so let's go and do the year one provision. Okay, so we had a book loss of 2,000, right? And that included amortization of 1,000 and depreciation of 400. Is that right? Okay. So if I was trying to get to my taxable income, what would I do? So I would add back my amortization and my depreciation. I don't have to add it all back, it's just going to be different. Right? Or is it actually the same? It's the same. So I have no difference. So I have $1,000 loss, which means my payable is 0, right? Okay, so if I was doing my deferreds, let me do a little beginning of the year, end of the year table here. Current year activity. So at the beginning of the year, I had intangibles of 1,000 and NOLs. Oh, that's not right. Oh man, that's a killer. Let's see if it'll open right back to that page. Well, we lost all that. Okay. So let's redo that just quickly. Okay. So we said I had PBT of 2,000. Included in that was an amortization expense of 1,000 that I can't deduct for tax purposes. So my TI is $1,000 loss for year one. So my payable is 0. Okay, so if I was doing my deferreds, I would take beginning of the year, end of the year, and I would say I had intangibles and NOLs. The intangibles was 5,000, NOLs was 8. So net 3, 35%. 1050. We have a VA of 1050. Nothing. So in the current year, my 1,000 of amortization means that this guy goes down by 1,000. So this is now 4,000. My NOL went up by 1,000 because I lost $1,000 on my tax return, right? That goes right there. So now my NOL is up to 9. I'm net 5. That's 1750. Is that right? 35. That should be right. Oops. We'll call that 35%. 1750, VA of 1750, 0. Okay, so no change in my deferreds, no payable, no nothing. Right, so year one is easy, because all I did was keep losing money, keep building my VA. Why do I exclude depreciation? I excluded depreciation because in here, depreciation for books was 400, and for tax it was also 400. So my basis on day one was the same, so I had no deferreds there, and I have no difference down here. So the fact I gave you depreciation as one of the facts was a little bit of a decoy, because there's actually no difference between book and tax. Okay, we good with year one? Why do I always have a VA? Well, so I assumed that I needed a VA here because those were the facts. right? So when I looked at my facts on the first page of the in-class exercise, I said I was more likely than not to not be able to use my NOLs. And I just assumed that since all I was doing was building my NOLs, I just assumed I was keeping my VA. Okay. All right, year 2?
So where'd you get the end of year 1750? I see that once you did the 5,000 at the end of year, 135%, you got 1750. But where did you?
And that's it. I just took this number,
Yeah.
A times B,
Yeah. And then.
that's it. And then I just put this as an offset. Okay, so let's go to year 2. So year 2, book income of 3,000. Okay, let's actually shortcut it and make it more exciting. Let's say that year 2 and year 3 are 1 year. Let's say we made 6,000 bucks. Okay. Okay. And just to see if you guys got the right answer, I'll even include 2 years worth of amortization and depreciation in there. Okay, so PBT 6,000. Okay. Amortization expense that's in there, if it's 2 years worth, we're doing 2 years at once here, we're doing like massive shortcutting. I would not recommend you do the final 2 years in one provision. You will be getting a nasty email from Anna, that's for sure. Okay, so that would be 2,000 of an add back, because that's book expense of 2,000, we can't deduct it. So that means my taxable income would be 8,000. Right? So I said that on the prior year provision, my NOLs were 9,000. Right? So I'm going to have NOLs of 8,000. So I'll have nothing here for my current payable, forget AMT and all that kind of junk. Just assume that we have a full offset, no provision. Okay? So my intangibles was 4,000, and my NOL was 9,000. That was a net 5, and after the VA, it was a 0. So in the current year, this DTL is going down by 2,000, so I'm only going to be left with 2,000 at the end of the year. But my NOL, it goes down by 8,000. So I'm only left with 1,000 at the end of the year. So I actually have a net DTL of 1,000 at the end of the year. So I have, at the end of the year, I actually have a net DTL. Right? I've burned through most of my NOLs, but I still have more IP DTLs, intangible DTLs. So even though I was kind of in full VA, like happy land, right? All of a sudden, because I made all that money, I wiped through my NOLs, but I'm still stuck with some DTLs, right? Because those are amortizing off kind of slowly. So you can get in a situation where all of a sudden, even though you thought of yourself as like a loss company with net DTAs and VAs, all of a sudden, boom, you're into net DTL land, and now you have a provision. Because your payable here was 0. Your change in deferreds was a net 350 credit, which means your provision is a $350 debit. Right? So this year, on our PBT we had a PBT of $6,000 and a provision of $350 because we just barely came out of our valuation allowance. Right? So our provision is kind of weird this year because we're just barely coming out of our valuation allowance. How am I getting 1050? Oh, that's a typo. This should really be 1750. Doesn't matter. The key number is this number, 0. You get credit for being awake, though. More power to you. So if we were doing a rate rack for this company, we would say PBT 6,000 at a 35% rate. We would expect a provision of 2,100, and we ended up with 350. Right? Our VA release, and if we had done this before Jose made his comment, we would have realized that the valuation allowance went from 1750 to nothing. Right? So the valuation allowance went down by 1750. Boom, there's our rate rec. Okay, you got it? Okay, key is you got to be able to determine there's an opening basis difference on your balance sheet because it targets acquired attributes, right? Book versus tax basis. Set up the opening deferreds, book them through goodwill, right? And then know once you set up those deferreds, they have to reverse just like any other item, any other temp item that's on your deferred schedule, right? So the key is to set it up in a special way. It's not like how we set up deferreds before where we did it through the current calc. These are just going to show up through a goodwill entry. But then they reverse just like any other deferreds. The reversal isn't anything special. It's the setup that's special. Okay, you're going to set them up through goodwill, reverse them through our normal process. Okay? Okay, let's think about what else we have to cover here. Let's cover transaction costs for a bit. This is good times. Everyone has this issue. This is not on the final, in case you want to just stare into the abyss. But this is relevant if you ever have to do a provision with an acquisition. Okay, so you're buying a company. We're buyer, somebody else's target, right? When we when there's an acquisition, there's two groups of people that get rich. Who are the two groups of people that get rich in an acquisition? Seller's one. Who's the second? Who? What'd you say, Eugene? Firms? What kind of firms? I didn't hear what you said. What'd you say? Partners at Deloitte. That is not the right answer. Who's the second person to get rich? Lawyers is close. Investment bankers. Yeah. It's funny, I don't know if you guys read tax notes very regularly, but there was an article that Lee Shepard wrote. Lee Shepard's like a famous journalist that has worked for tax notes forever. And in one of her articles, she talked about how if you ever want to be rich, don't get paid by the hour, and which is what partners at Deloitte do. And and they said you should be an investment banker, and you know, because they get these big fees for doing sometimes a small amount of work. And so, anyways, when you look at an acquisition, and you look at the costs incurred to facilitate the acquisition, usually, not always, but usually, the vast majority is investment bankers. So, not every transaction has a banker. It just depends. But usually big transactions have bankers, big fees. And bankers work like real estate agents. You know, you go to them and say, I want to sell my business. It's like saying, I want to sell my house, right? And they're like, all right, we can go sell your business. And they go out and sell it, and then they get a percentage of the deal, right? It's just like how the realtor gets a percentage of the sales proceeds in her house. It's the same thing. It's just a more unique transaction with bigger dollars, and you know, the network of the banker is that much more important, right? And their ability to sell your company. So, so it wouldn't be surprising if, like, let me think of one of my clients. It was actually a pretty large public company, and they were sold for around $3 billion. The banker fee on that deal was around $40 million. Right. Right. So imagine selling your house and you get a commission of $40 million. Right. You put an open house sign on the corner for that. You can have drinks at the front door. So, so when that company looked at the cost of that entire deal, like the fees were for the accounting firms were not small, the fees for the lawyers were not small, but the investment bankers were like, dun, 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 right? Huge fee. And so, so for the most part, when I look at transactions, I kind of look at investment banker fees, because those are the fees that are usually the vast majority of the total, and those are also the fees that are usually questionable in terms of whether they're deductible or not. So most times lawyer fees are capitalized costs. So remember, we're the buyer. That's what we're trying to embody through tonight's class. So if we were the buyer and we bought a company and we had a lawyer, an accountant, and an investment banker, it's almost a sure thing that the lawyer's fees are going to be capitalized under 263, 263-5. And usually the accounting fees are pretty similar. They're going to be capitalized under the same rule. Okay? The banker fee, that's the question, is how's the banker fee treated? Because the argument with the banker fee is that I'm paying this banker to help me figure out what to do. Not to negotiate like purchase price and seal the deal, but like what to do. Like, should I go buy a company? Should I grow my own business? Should I, you know, steal somebody else's technology? Like, help me, advise me, tell me how to run my business. Like, what should I strategically do? Like, that's in theory why I'm hiring an investment banker. So, even though I kind of analogized it to the real estate agent thing, it's more complex than that, right? You hire an investment banker for advice, right? And so, oftentimes companies who are going public, they would say, you know, should I go public or should I sell myself? You know, either way, I kind of monetize my investment. But what should I do? Like, what's the best thing for my shareholders? What's the most, you know, optimal way to realize the value of my business? And in theory, an investment banker will help you figure that out, right? So if you're paying an investment banker for advice on what to do, that's usually deductible. But if you say, hey, investment advisor, like, I want to buy this company, I want to buy them tomorrow, this is how much I want to pay, go do it, and I'll pay you a percentage for doing it. Right? Like, I've already decided what I'm going to do, I just want it done. I just want you to execute on this deal. And the banker will be like, for $40 million, I will happily go do that. Right? So that fee is usually capitalized, because there you're just facilitating an acquisition. Right? And so usually with a banker, you have to figure out what were they doing. Right? How are they spending their money or their fees? How are they spending their time? Because once you understand that, you understand how it's treated for tax purposes. Maybe it's deductible, maybe it's capitalized. Okay? But no, with an investment banker fee, it's always questionable. And a couple years ago, the IRS came out with a safe harbor, and they said, if you pay a success-based fee, which is usually how bankers get paid, almost always. Meaning, if you do a deal, I get paid. If you don't, I don't. Right? Just like a real estate agent. The IRS safe harbor said if there's a success-based fee in connection with an acquisition, that the IRS will say, as long as you don't take more than 70% of the fee and treat it as deductible, we won't come out at you and fight you on it. But if you take like 75% and you get all piggish, then we're coming after you and we're going to debate whether that was the right percentage, because we maybe think differently. And actually, the safe harbor was pretty friendly to taxpayers. 70% is kind of a high number. I think most people were surprised when that safe harbor came out as high as it did. Because a lot of companies would reserve for financial accounting down to much lower percentages. They would assume like we might only get 40% or 50% or that sort of thing. That was common. So when the IRS said, we'll give you 70, everyone's like, oh, sounds pretty good. But that is kind of the dynamic, right? Is you're incurring costs, you're going to do a deal, and now the question is, how do you account for those? Okay? So the rules for book accounting changed back when all these other changes happened that I keep referring to, like 5 years ago. It used to be that if you paid a banker $40 million to acquire a company, it would be treated as purchase price. So it would end up going into goodwill. Just like when you buy a stock from a broker, right? If you pay, $40 for a share of Oracle and you pay a $2 commission, your basis in the share is $42. That's kind of how it works with companies, right? You buy a company for $1 billion and you paid a $40 million fee, then your basis in the company is $1.04 billion, right? Same sort of thing. So that's how book accounting used to work. But now, the companies have to expense acquisition costs. So that $40 million in my client's example, I don't think I want to tell you who the company was, but the buyer, who's another local company, they had to expense that. So in their P&L that period, there was a $40 million expense for paying the banker. So if there's a $40 million expense in their financial statements, we got to figure out if it's tax deductible or not. Right? Because we're starting with PBT that includes a $40 million expense. We got to figure out what our tax deduction is. It could be 0. It could be 70% of 40, which is 28. We could be pigs and take all 40. Right? It could be any one of those three. And then you throw in the lawyers and accountants and all that kind of stuff. Right? So it gets a little complicated, but know that books starts with an expense, and then tax has to figure out what to do next. Okay? The other complexity is, so lawyers and accountants do kind of get rich, not super rich like bankers, but there's big fees with lawyers and accountants too, right? And so the twist with them is, like, take that same deal with the big banker fee. We were working on that deal, and attorneys were working on that deal before anyone else knew about it, right? Like, it was kind of in the shadows for a while. And so that means, like, when I sent my client a bill, there was an expense, but there was no deal yet, right? So now I have to figure out whether that expense is deductible or not, and it relates to a deal that no one even knows is there. So that's tricky because companies are now expensing costs before there even is a deal. And that happens every time there's a deal, right? There's always expenses being incurred before the deal happens. That's how the deal happened. So it becomes a little bit of a difficult situation to know how should I account for that expense when I don't even know if there's a deal or not, right? Because let's say they paid me $100,000 for helping. So if they do a deal, maybe that's capitalized, maybe it's non-deductible. What happens if they decide, you know what, we're not going to do that acquisition? What happens to my fee? Do they get to deduct it? Yeah. So whether or not they do a deal actually changes how my costs that get expensed before there is a deal, how those get treated. So it's almost like you have to have a crystal ball, right? So if it's Q3 and I send them a bill and they expense it, in order for me to know whether I should treat that as perm or deductible, I kind of have to know if there is a deal in Q4. So costs can be, dealing with transaction costs can be complicated, and the numbers can oftentimes be pretty big. So even though it sounds like kind of a rounding issue at the end of the day, cost can be complicated. Okay, so the keys are, so with that as kind of my, my rant on the topic, let's go through the slides. So books, expense, tax, either capitalized into asset or stock, depending on what the deal is, or they could be deductible. Could be deductible, depending. Oh my gosh. Getting my little button. Okay. So books is always expensed. Tax depends. Okay. So let's use the lawyer example. Okay. So let's say I'm a calendar year company. It's Q3. The lawyer sends me a bill. It's like $3 million, right? And they're like, help with special project, $3 million. So books is going to expense it. So when I'm doing my provision, what do? Do I treat that thing as a perm because it's going to be capitalized and they're going to do a deal? Or do I treat it as deductible because I think they're not going to do a deal and I think they'll just fail? So there's two approaches. Okay? You can either assume view 1, which is don't anticipate the deal. Okay? So if you don't anticipate the deal, you just assume there is no deal until there's a deal. Right? And if there's no deal, it's deductible. Okay? So all along, in Q3, that $3 million bill you treat as deductible because you don't know any better. Right? You're like, there's no acquisition that I know of. No one's completed anything, so nothing's non-deductible yet. So if later in Q4 you actually do a deal, then those costs you deducted in Q3, that actual stuff, gets determined later and you true it up. So you might actually have to book a perm in Q4 to rectify the fact in Q3 you treated this stuff as deductible. Okay? But this view is premised on every time you look in a period and you're computing the provision, you treat the costs as if there is no deal because yet there's no deal. Okay? The second approach is crystal ball. Right? You say, you know what, I think there's going to be a deal, so I'm going to account for these costs as if there's a deal. So you book the expected tax consequences each quarter. Okay? So when the new rules came out like 5 years ago, they let companies choose, or buyers could choose between view 1 and view 2. So which view do you think everyone chose? Which one? 1, of course. Everyone chose 1. It's funny when I hear people talk about their choices and whether view 2 is adopted. I'm like, I don't know a single company that chooses view 2. So know that as costs are incurred, you have 2 choices. That's the way the rules work. When you read like our roadmap book that we sent out, it'll talk about the 2 choices. And it'll sound very academic, but in practice and reality, everyone uses view 1. And view 1 is easy, right? View 1 is, I don't do anything special until it's obvious there's an acquisition, and then I figure out what all the consequences of the acquisition are, right? I mean, that's the common sense way of doing it. All right, I'm going to skip to this example. All right, so let me hit some other kind of frequently touched on items. You guys have any questions about cost before I get off that topic? You guys don't want to walk out of the room and be investment bankers now? In the wrong class? Okay. So this is a really, really common topic, measurement period. Okay, so when you do an acquisition, the idea is that you have on that quarter, like let's say you're a calendar year company, and on September 15th, you buy a company. So you're going to file your financial statements for the period ended September 30th. So that gives you a whopping like 15 days after the close of the acquisition to go figure out what to put on your opening balance sheet. So that's not good, right? Like let's say you did a big acquisition. So that means that you got to go figure out, what their NOLs are, right? What their exposures are, what their state tax rate is. If it's a company that's all over the place, this might be hard to figure out. There could just be a lot going on, right? What if you bought a target, like that company I was just referring to with the big banker fee? I mean, they were probably in 40 countries, right? So you got 40 countries full of deferred tax assets and liabilities and payables you got to go figure out, right? And if they did that acquisition on September 15th, and then September 16th, a bunch of people were like, we quit, we got a lot of money, right? This is going to take a while. It's going to take a while to go figure all that out. So booking that entry, like we showed in that one slide where we booked the 420 to DTL and goodwill, like that's nice and all, but in bigger, complicated transactions, that's hard. I mean, it's really hard to figure all that out. So the accounting rules allow you a measurement period where if you can't figure it out in the first period that you account for the transaction, you get sort of an extension of time to kind of true it up later. So if, for example, the next quarter, like you acquire this company in Q3, but in Q4 you realize, I have more NOLs. I was just getting around to figuring it out. Well, then the next quarter you could book another entry of debit, DTA, credit, goodwill. Right? You could true stuff up so long as what you're doing is dealing with the facts that existed at the acquisition date. Right? Things that happen after the acquisition you account for through the provision. But if you're just trying to crystallize what assumptions, what facts existed at the acquisition date, you get to keep truing up goodwill for up to a year. Okay? So sometimes this gets confusing because there's often confusion about how this 1 year rule works. This is the rule. So it can be less than a year, and here's why. Okay? So the first part of this rule is right here. The period ends as soon as the acquirer receives the information it was seeking or learns that more information is not attainable or obtainable. Okay? That's part one. So if you get everything you need to know, and that happens within like 3 weeks, your measurement period's over after 3 weeks. Okay? You can't 10 months later be like, you know what, I had it all, I stuffed it in a drawer, I'm kind of lazy, I just got to it, now I'm going to book it? The answer is no. You had everything you needed, you're supposed to book it in that period. You don't just automatically get a year because you get a year. You get as much as a year, but once you have everything you need, you're done. So what companies will do after they acquire another target is they'll usually put a statement in there that says we haven't received all the information we need yet to do our opening balance sheet. And that's your cue for, they're trying to stretch out their measurement period. That's what they're doing. Okay? So that's part one is you have until you get the information. Part two is it can't exceed a year. Okay? So it'll never be more than 12 months, but it could be 8 months. It could be 4 months. In some companies I work with, I find that the finance guys like to finish in the first quarter and say, we're just so good, we're so smart, we're so on the ball, we're done, everything's cool, we're moving on, we're not adjusting this later, it's very clean. And the tax guys are like, hold on a second, this isn't good, I got to go figure out my NOLs, and I got to go figure out that, this is going to take forever, and I haven't even started thinking about that. Right? That's typical, because the tax guys would say it's harder for us to go get our arms around all the data that goes into the opening balance sheet than it is for the accounting guys. And that may or may not be a fair comment, but that's a typical conversation with a large company and a large deal. But know that you get up to a year, but you may not get a full year. Okay? And then everything that happens outside of that generally goes to provision. And there's this exception for what's said at the bottom of the page here, but I'm not going to go into that. Okay. So this is that disclosure I was talking about a second ago, where if companies aren't done with their purchase accounting, if the initial accounting is incomplete, you're supposed to do all three of these things. So you'll see a little statement in there. It'll be very brief, but it'll speak to those things. So sometimes when you see a company's 10K, you know, you guys have gotten used to looking at their UTB roll forwards. And sometimes, you know, the whole idea of that UTB roll forward is to explain what would happen, if you looked at the beginning balance of my exposures and I rolled it forward to the ending of an exposure for the year, like how would it change if I did an acquisition? So in this sample table, what this company was saying was, at January 109, I had 114 million of exposures, but then I bought this company, right, and I assumed their exposures, and they had another 117 million. So at the end of the year, I had 285. So sometimes this table is kind of interesting because normally you would look at it and say, how aggressive is this company? What's changing? Is the IRS going to come out and get them? Do they have exposures all over the world? Like, you look at this table and you try to kind of get a sense for what's happening, right? And then if a company has something like this, you say, oh, geez, they bought this company, and man, that thing came loaded with a whole bunch of exposure for taxes, right? So seeing a line like that would tell you that the tax guys are going to be busy, right? Because they got a lot of exposure that comes along with them. One of the more interesting things is, so I remember when that same deal I keep referring to, when the client, the target, was a standalone company. It was a public company, filing 10Ks and all that. Their number here, let's call it 100. I don't remember what the exact number was. Let's say that their total exposure was 100. And then they got bought, and the buyer kind of took a fresh look at the exposures, and they said, man, I don't know about that 100. You guys seem like you're in deeper doo-doo than 100. So they ended up booking like 400. So if you were really paying attention, you could have seen on their last 10K one reserve number, and then gone to the buyer's 10K to see their roll forward, and you would see in this column, this row, the number that they assumed was way bigger than the liability that the target had to have assumed. And this is kind of an editorial comment, but what was happening there is, do you remember how I was talking about what companies are incentivized to do and how they're incentivized to be conservative up front? That's why this number got so big. Because these guys are like, look, if we're under reserved, we're going to have to expense anything additional through the provision. But if we accrue a big number in the opening balance sheet, we get to book this through goodwill. So in theory, it doesn't make sense that the target's number here would be any different than the buyer's number here. It's the same number. The only reason you get to different amounts is because two different people are applying two different sets of judgment. But for it to be a factor of like 4 times one number to get to the second number, that's a little crazy. Anyway, so interesting anecdote. Okay, so we were going to pull up Yahoo's 10K, and let's find out. Let's see if we can find. Going slow. Maybe this isn't going to work. As they change their so I was going to show you the when they acquired Tumblr, when Yahoo acquired Tumblr in Q2 of this year. You know, this building is not good for internet connection, at least with my phone. Alright, so this is, let's see if we can get it to go quicker here. Alright, I'm not going to make you watch my pages sit there and reload. So if you have the intellectual interest, here's what I would tell you to do. If you pulled up the 10Q for Yahoo in Q2, what you would see is when they bought Tumblr, they paid, I don't want that. They paid around $1 billion. But it's funny because, you know, I remember I got so many like emails from people I knew that knew I was working with Yahoo, and they thought, oh my gosh, that must be a huge deal. But one thing that you have to learn about Silicon Valley deals is that just because it's a big purchase price doesn't mean it's a big company. And with Tumblr, let's see if I can shrink this down a little bit, fit within the screen. Alright, you guys got to be good with eyesight for that. I just want to try to get on the video for the recording, that's all. Okay, so when you look at a company's financials, you know, they'll, in addition to having tax footnotes, they'll have footnotes for acquisitions. So the largest transaction that Yahoo did was the Tumblr one in Q2. And so they'll include this table, this is typical. They'll include this table that says the total purchase price was $990 million, and it was made up of this stuff. So they basically said we paid $1 billion, and for that we got some tangible assets of $70 million, intangibles, which included developed technology, customer contracts, and trade names for about $250 million, and then goodwill was $750 million. Okay? So if you think back to that little slide with the book column, the tax basis column, the difference, all these intangibles, the book value is like $250 million. The tax basis, 0. Right? So we would book a DTL, and we'll go see in a minute if we can figure that out. We would book a DTL for like $100 million. Right? Because we would say that $250 million has no tax basis, so we needed a DTL for that. But remember, the rule is that with goodwill, they have $750 million of goodwill, and again, no tax basis, right? But so we did nothing. There's no DTLs for that. So when we look in the disclosure, let's see if we can, usually there'll be one or two things in here that we care about. Okay, the amortizable intangibles have lives of 6 years and a weighted average of 6 years. No amounts have been allocated to IPR&D. $750 million of goodwill. Goodwill represents the excess purchase price over the fair value of the net tangible assets. Ah, here's the tax piece. This is as a tax person, here's your contribution. And is not deductible for tax purposes. Okay, so that's a required disclosure in an acquisitions footnote. And that's your clue for we don't have a DTL on that $750 million. So whenever you see a footnote like this and you see the purchase price allocation, if there's goodwill and you want to know if it's tax deductible, just go look for the sentence. It'll always be there. Okay? I think that's the only thing that they probably say about taxes. Let's see if we can find something else. Alright, so we'll look in their tax footnote to see if they say anything about the acquisition, but I'll bet they don't. Yeah, I don't think so. I think that's literally it. So, what's interesting is, even though on that transaction, if we go back, alright, so we go back here. So this is that same purchase price allocation table. So, when they say they acquired the company and assumed liabilities of $113 million, what do you think those liabilities are? Remember, these are like 6 guys sitting in the garage. How did they come up with $113 million in liabilities? Yeah, it looks like about the right amount, huh? You think that's coincidence? That's definitely not coincidence. Alright, so that was the tax guys. They're adding value. They're putting $100 million of liabilities on the balance sheet. We're not getting a lot of credit by not having the word tax in there, but that's definitely what that is. Okay. Alright. Okay, next class. Next class is we're going to do quarterly provisions. Okay, so far in this class we've always talked about annual provisions. Quarterly, totally different. So when we do annual provisions, in the first class we learned how you do the payable first, then the deferreds, and the provision comes out. Quarterly is the opposite. We'll start with the provision, and then we'll figure out what to do with the balance sheet. Okay, so everything is like opposite world. Okay. Quarterly provisions, you got to do them 3 times a year, versus annual, you got to do it once. So we do lots more quarterly provisions than we do annuals. Right? Quarterly provisions, they're interesting. They have a, it feels like there's very few rules, but yet there's a lot of like, how do I deal with that sort of situations with quarters where there are no rules? So one of the most common questions that comes up with quarterly provisions is, how do I adjust my deferreds versus how do I adjust my payable? Like, how do I do the balance sheet accounting? I used to joke around with you guys, and I used to give extra credit for coming with the authority that would explain how to adjust your tax balance sheet accounts every quarter. And the answer is there are no rules. So I'd send you guys off looking for a while. But that makes it difficult, right? So if you compute what your provision for the quarter is, and it's $100, and you have to figure out what the other side of the entry is it deferred, is it payable? There's not really a rule that tells you that. So it's funny. Like I said, it's kind of the opposite of how annual provisions work. So we're going to learn how to do quarterly provisions. So here's what I want you to do for the homework. Find 3 public companies. I don't care which ones. Go and get Q1, 2, and 3. So pick a company that's like calendar year that would have already had Q1, 2, and 3 earnings. Okay, should be easy given where we are in the calendar year. So go find Q1, 2, and 3, map out the ETRs, explain why the quarterly rates go up and down. Okay, so in one quarter it's 34%, the next quarter it's 28%, the third quarter it's 31%. Explain why it goes up and down. Okay? You'll pull some companies and you'll find that the rate is very stable every quarter. Some companies, the rate's bouncing all over the place. Okay? Figure out why. Why are some companies stable? Why are others volatile? Figure out why some companies' rates go up, why others go down. See what you can figure out. Do it from public disclosures. I mean, you guys are going to have some inside track on this. So what you'll find in reading public disclosures is sometimes hard. It's hard to figure out what's going on. But take 3 public companies, map out their quarterly rates, and explain why they're going up and down. Read the LinkedIn 10Q. Nina will be here next class, so come with questions for her. And then send in your case study by November 26th. Okay? So our next class is December 3rd. Is that right? Whatever the Tuesday is after Thanksgiving.